studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
Now that we understand the corporation is responsible for maintaining its own capital dividend account records, the next question is, how do we summarize all of that information in one place? The answer is Schedule 89. Schedule 89 is the CRA form used to calculate, document, and, if requested, verify a corporation's capital dividend account balance. A helpful way to think about Schedule 89 is as the corporation's CDA report card. It gathers all of the transactions that have affected the CDA and summarizes them into a single calculated balance. Let's look at the inputs shown on the left side of the slide. The calculation starts with all the transactions that affect the CDA. Non-taxable capital gains increase the balance. Non-deductible capital losses reduce the balance. Capital dividends received increase the balance. Capital dividends paid reduce the balance. Life insurance proceeds may increase the balance. And trust allocations can either increase or decrease the balance depending on the circumstances. All of these historical transactions flow into Schedule 89. The form then combines the additions and reductions and calculates the corporation's current CDE balance. The result is shown on the right side of the slide. A calculated CDA balance that represents the corporation's available tax-free capital dividend capacity. In other words, Schedule 89 helps answer one of the most important questions in corporate tax planning. How much can potentially be paid to shareholders as a tax-free capital dividend? Notice the information flow shown on the right. Historical transactions are gathered. Schedule 89 is completed. A CDA summary is calculated. And that information becomes available for future planning decisions and potential capital dividend distributions. This is why Schedule 89 is such an important tool for tax practitioners. It organizes years of historical information into one structured calculation. It documents how the balance was determined. It supports future elections and filings. And perhaps most importantly, it helps reduce the risk of paying an excess capital dividend. A very important memory rule appears at the bottom of the slide. Schedule 89 does not create CDA. Schedule 89 simply summarizes CDA. The underlying transactions create the CDA. The form is merely a reporting and tracking tool. So whenever you think about Schedule 89, remember its primary purpose: to collect all CD-related transactions, calculate the current balance, and provide a reliable summary for future tax planning and compliance. In the next slide, we'll see why many practitioners choose to request CRA verification of the CDE balance before paying a significant capital dividend. Now that we've learned how Schedule 89 summarizes the capital dividend account, let's discuss one of its most practical uses: requesting verification of the CDA balance from the Canada Revenue Agency before paying a significant capital dividend. Imagine that a corporation is planning to pay a capital dividend of $500,000. Before making that payment, management and their tax advisors face an important decision. Should they proceed immediately based on their own calculations? Or should they first request CRA verification of the CDE balance? Let's look at the two options shown on this slide. The first option is to pay the dividend immediately. While this may seem faster, it comes with risks. If the CDE balance has been overstated, the corporation could end up paying an excess capital dividend. That may trigger Part 3 tax, interest charges, penalties, and potentially costly corrective filings. The second option is to verify the balance first. This typically involves preparing a detailed CDA calculation, completing Schedule 89, and requesting CRA verification. Although this process takes additional time, It provides greater confidence that the corporation's records support the amount being distributed. Let's walk through the verification process. First, the corporation gathers all historical CDA records and prepares a detailed CDA calculation. Next, Schedule 89 is completed to summarize the calculation. The corporation may then submit a request for CRA verification. CRA reviews the information provided and compares it with the records available to them. If everything appears reasonable, CRA provides confirmation of the balance based on the information submitted. At that point, the corporation can proceed with much greater confidence when paying the capital dividend. Notice the comparison at the bottom of the slide. Without verification, there is greater uncertainty. The risk of overpaying a capital dividend is higher, and if a problem is discovered later, the corporation may face taxes, interest, penalties, and additional compliance work. With verification, the risk is generally lower. Documentation is stronger, the audit trail is clearer, and tax planning decisions can be made with greater confidence. It's important to understand one subtle point. CRA is not maintaining a continuously updated CDA balance behind the scenes. The verification process is based largely on the records and calculations provided by the corporation. That's why good record-keeping remains essential, even when verification is requested. For tax practitioners, a useful checklist is shown on the right side of the slide. Maintain detailed historical records. Compute the CDA carefully. Complete Schedule 89 accurately. Request verification when appropriate. Review CRA's response. And document everything before proceeding with a dividend payment. The key takeaway from this slide is simple. Before paying a significant capital dividend, verify the CDA balance and consider requesting CRA confirmation through Schedule 89. A little extra diligence before the dividend is paid can help avoid substantial tax costs and compliance problems later. And that's why requesting verification is widely considered a best practice in professional corporate tax planning.